Welcome back to the channel, where we dive deep into the fascinating world of hard-to-borrow stocks and potential short squeeze scenarios. Today, we're putting a specific microcap name under the microscope, one that's been flashing some intriguing signals on our screeners, ZCMD, or Zhongzhou Inc. We're going to break down why this stock is attracting attention from a short interest perspective, and what it could mean for traders. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, who exactly is Zhongzhou Inc.? ZCMD operates in the healthcare and health information services sector, providing vital healthcare information, education, and training services to medical professionals in the People's Republic of China, primarily under their endemic brand. They operate through two segments, endemic services and sales of patented drugs. With a market capitalization of just $6.02 million, ZCMD is firmly in microcap territory. Looking at recent price action, ZCMD has seen quite a bit of volatility. Today, the stock is down 2.91%. Over the last 5 days, it's dipped 12.28%, and looking at the past 30 days, ZCMD has seen a significant decrease of 55.36%. Volume-wise, today we saw 6,442,394 shares trade hands, which is about 0.7 times its 30-day average volume of 9,764,703 shares. What is cost to borrow and why it matters? Before we get further into ZCMD specifically, let's quickly explain one of the most critical metrics we track, cost to borrow, or CTB. When you short a stock, you're borrowing shares from a broker to sell them, hoping to buy them back later at a lower price for a profit. To do this, you pay a fee, much like interest on a loan. This is the cost to borrow. When a stock is hard to borrow, it means there's a high demand from short sellers to borrow those shares, but a limited supply. Naturally, this scarcity drives up the borrowing fee. A sky-high CTB is a direct cost to short sellers, eating into their potential profits and adding pressure on their positions. Why this stock is hard to borrow right now. And this is precisely where ZCMD enters our radar. Our screen has picked up ZCMD because its annualized cost to borrow fee is an astronomical 846.6%. That is an exceptionally high figure in the market, indicating extreme demand to short this stock, or perhaps an extremely limited supply of shares available to borrow. Unfortunately, specific data on CTB momentum and shares currently available to borrow is not publicly available for ZCMD right now. However, we do know ZCMD has an estimated float of just 1.1 million shares. A small float means fewer shares are actively traded and available, which can rapidly exacerbate borrow scarcity when short interest is high. Our internal composite squeeze score, which factors in metrics like CTB level, float size, and volume, currently gives ZCMD a score of 47.5 out of 100, suggesting some interesting underlying dynamics. Squeeze mechanics explained. So, what does this all mean in the context of a potential short squeeze? A short squeeze happens when the price of a heavily shorted stock rapidly rises. This sudden increase can be triggered by positive news, an unexpected catalyst, or even just sustained buying pressure. As the stock price climbs, short sellers begin to lose money, and their borrowing fees, especially at rates like 846.6% for ZCMD, become increasingly painful. To limit their losses, or due to margin calls, these short sellers are forced to cover their positions, meaning they buy back the shares they initially borrowed and sold. This forced buying creates even more demand for the stock, further driving up the price, and creating a feedback loop that's a squeeze. It's important to remember, though, that a high cost to borrow doesn't guarantee a squeeze. It could also signal that short sellers have strong conviction and are willing to pay those high fees to remain short. Dilution risk check. When evaluating a potential short squeeze candidate, we always check for dilution risk. Dilution occurs when a company issues new shares, increasing the total number of shares outstanding. This typically dilutes the value of existing shares and increases the supply, which can effectively negate or severely hamper a short squeeze, even with a high cost to borrow. For ZCMD, we found no recent dilutive SEC filings such as -1s, -3s, or 424Bs in the last 90 days, which is a positive sign for short squeeze potential as it reduces the immediate risk of new shares flooding the market. Recent reverse split watch. Now let's talk about something else critical for ZCMD, its recent reverse stock split. ZCMD executed a 1-4-3 reverse stock split on June 29, 2026, which was 46 days ago. A reverse split reduces the number of outstanding shares and, in turn, resets the share price higher on a per-share basis. For ZCMD, this action significantly reduced its float, potentially making those remaining shares even more coveted by short sellers or more sensitive to buying pressure. Historically, many microcap stocks tend to see renewed volatility or even a price pop within about a month after a reverse split, as the market digests the changes. While ZCMD is slightly past that 1-month window, the impact of the reduced float and the general pattern is still relevant context for its current trading dynamics. This is a pattern we've observed, not a guarantee of future performance. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. For ZCMD, given its current 846.6% CTB and small estimated float, what should you be watching for? Key indicators would include a significant increase in trading volume, potential positive news that challenges the short thesis, or sustained buying pressure that starts pushing the price upwards. If available shares to borrow diminish further or the CTB rate continues to climb, it could signal increasing pressure on short sellers. Remember, short sellers pay a daily fee, and extremely high rates like ZCMD's can become unbearable over time, forcing them to cover regardless of their conviction. ZCMD, with its healthcare information services in China, presents a fascinating case study in the world of hard-to-borrow stocks. The astronomical 846.6% cost to borrow, combined with a small 1.1 million share float and the recent reverse split, certainly puts it on our watch list for unusual activity. While the stock has been trending down lately, these underlying factors could create interesting dynamics. Always approach such situations with caution, conduct thorough due diligence, and understand the inherent risks. If you found this breakdown helpful, please smash that like button, subscribe for more in-depth analyses, and let us know in the comments what stocks you'd like us to investigate next.